Retire early with these 5 monthly paying ETFs, not JEPI or JEPQ. Ever wondered what a $10,000 investment could do for you? Would you believe there's a simple way to turn that amount into a passive income machine that pays you over $5,200 every single month? Money that can cover your bills, fund your lifestyle, or be reinvested for even greater returns. Sounds too good to be true? Lucky for you, it's actually achievable with these 5 high-yield ETFs that pay monthly dividends, putting reliable income in your pocket month after month. And no, we don't mean the well-known JEPI and JEPQ. Today, we're taking it a step further. We've found 5 ETFs that not only pay dividends monthly, but could even outperform the usual favorites. And here's the best part. We're not just throwing a list at you. By the end, we're putting these ETFs together in a way that balances risk, boosts income, and still leaves room for growth. So stick around and let's build this passive income machine together. Why can these ETFs generate high yield? Straight away, you should know that this strategy does not include a reliance on the usual suspects like JEPI and JEPQ. We know most income investors know about these 2 heavyweights, but today we're going beyond them. We're diving into 5 powerful ETFs that not only pay dividends monthly, but in some cases outperform JEPI and JEPQ while offering a smarter approach to long-term wealth building. Monthly dividends are a game changer, especially for those planning for or already in retirement. Bills don't come quarterly, so why should your dividends? Having a steady, predictable income stream can mean the difference between stressing over market fluctuations and enjoying true financial freedom. But the real question is, how do these ETFs generate such high yields while maintaining growth potential? The answer lies in their strategic use of covered call options. Think of it like being a landlord in a prime location. You own a valuable asset, whether it's a rental property or a stock portfolio. Now, instead of just waiting for the property's value to rise, you rent it out and collect consistent income every month. That's exactly what these ETFs do. They own high-quality stocks and then generate extra cash flow by selling call options, essentially renting out a portion of their holdings. But here's where these 5 ETFs stand out. Unlike some covered call ETFs that rent out every single asset and sacrifice all upside potential, these funds take a more balanced approach. They keep a portion of their holdings free, allowing them to benefit when stock prices rise, while still delivering high monthly income. This combination of active management, high yield potential, and monthly payouts makes these ETFs a powerful alternative for income-focused investors. And in the next few minutes, we're going to break down exactly how you can use them to create a high-yielding portfolio that works for you. Whether you're looking to supplement your income, fund an early retirement, or simply reinvest for compounding growth, stay with me because this could completely change how you think about dividend investing. ISPY. If you're looking for a way to boost your income while still holding blue-chip stocks, ISPY might just be what you need. This ETF takes the S&P 500 and puts a unique spin on it by using a covered call strategy, but with a twist. Instead of selling options once a month like traditional covered call funds, ISPY writes options daily. That means it's constantly collecting rent on its holdings, generating extra income while still keeping exposure to some of the biggest companies in the market. Right now, ISPY is offering a dividend yield of around 4.79%. That's solid, especially for an ETF that's based on the S&P 500, which typically doesn't yield that high on its own. But here's the trade-off. Because it's selling call options every day, it gives up some of the upside when stocks rally. Think of it like renting out premium parking spots. You're making money consistently, but if the city suddenly decides to double parking rates, you don't get to fully cash in. Think ISPY is right for you? If you want reliable monthly income and don't mind giving up some growth potential, it's definitely worth a closer look. GPIX. This is the Goldman Sachs S&P 500 Core Premium Income ETF. Just like ISPY, if you're looking for strong monthly income without giving up blue-chip stocks, GPIX would be right up your alley. This ETF sticks to the S&P 500, so you're holding big names like Apple, Microsoft, and Amazon. But it comes with a smart twist. Instead of just relying on stock dividends, GPIX sells call options on part of its holdings, collecting extra income from option premiums. Think of it like owning a rental property, but also leasing out a few parking spots on the side. It's a steady way to bring in more cash. Right now, GPIX is dishing out an impressive 8.7% dividend yield. That's a solid payout, especially when compared to traditional S&P 500 ETFs. But there's a trade-off. Because it's selling covered calls, it gives up some upside when the market takes off. You're still in the game, but you might not capture all of the big rally. So who is this for? If you want broad market exposure but also love the idea of collecting bigger monthly checks, GPIX could be a great fit. It's designed to balance growth with reliable income without forcing you to choose one or the other. That's 2 down already, and we're talking huge dividends up to 8.7%. But trust me, the next 3, their yields are even crazier. You're going to want to see this. Next up, GPIQ. Now let's talk about the Goldman Sachs Nasdaq 100 Core Premium Income ETF. Because if you're looking for monthly income, but don't want to give up the explosive growth potential of tech stocks, this one might be right up your alley. GPIQ's strategy is pretty straightforward but powerful. It holds the biggest names in tech: Apple, Microsoft, Nvidia, Amazon, Broadcom, all the companies shaping our digital world. But here's where it gets interesting. Instead of just holding these stocks, GPIQ uses a covered call strategy on 25 to 75% of its portfolio. Now let's talk about income. GPIQ is currently paying out a strong 10.8% yield. That means for every $10,000 you invest, you could be looking at around $1,080 per year in dividends without selling a single share. And the best part? These dividends hit your account monthly. Of course, there's always a trade-off. Tech stocks can be volatile, and the covered call strategy might cap some of your upside in a roaring bull market. But for investors who want steady income, GPIQ is a beautiful option. SPYI. This is the NEOS S&P 500 High Income ETF, SPYI for short. Now, if your thing is serious monthly cash flow without diving into risky assets, this is exactly what you need. SPYI keeps things simple but effective. It holds the S&P 500, meaning you're getting exposure to the biggest, most stable companies in the US, like Apple, Microsoft, Amazon, and JP Morgan. But here's where it gets interesting. Instead of just sitting on these stocks, SPYI adds an options strategy to supercharge the income. And that income, it's no joke. SPYI is currently offering a hefty 12.54% dividend yield. That means a $10,000 investment could be putting around $1,254 in your pocket every year, paid out monthly. Of course, no investment is perfect. Since SPYI uses a covered call strategy, you might have to give up some upside in a bull run. But for investors who want strong, reliable income while still holding quality stocks, SPYI is a powerhouse pick. Hold on, don't start picking favorites just yet. We've still got one more to go. And trust me, this last one is an absolute game changer. You won't believe the yield on this one. QQQI. Now, if you're looking for the ultimate combo of high-tech growth and sky-high monthly income, QQQI, the NEOS Nasdaq 100 High Income ETF, might be your new favorite investment. This ETF is built on the Nasdaq 100, meaning you're getting exposure to the biggest innovators in the world. Apple, Microsoft, Nvidia, Amazon, Tesla. These are the companies shaping the future. But here's where QQQI flips the script. It layers on an options strategy to generate massive income. Think of it like owning beachfront real estate in a booming city. You're still holding prime property, big tech stocks, but instead of just waiting for the value to go up, you're renting it out and collecting steady cash flow every single month. And that cash flow? It's wild. QQQI is paying out a jaw-dropping 14.83% dividend yield. That means a $10,000 investment could be handing you $1,483 per year paid monthly. The one downside? QQQI sells covered calls too, so you might give up some upside if the Nasdaq takes off. But for anyone looking to generate serious income while staying invested in the biggest names in tech, QQQI is an absolute income machine. Now imagine combining these 5 powerhouse ETFs into one portfolio, balanced, high yield, and built to generate serious monthly income. Let's break it down. So here's the breakdown. These 5 ETFs give us an average portfolio yield of 10.37%. That's some serious monthly cash flow. But here's the thing. Higher yield often means higher risk. Some of these ETFs are more conservative, while others lean into aggressive strategies. You don't have to go all in on every single one. You can mix and match based on your comfort level. Want to play it safer? Lean toward the lower yield picks. Want to maximize income? Tilt toward the higher yield options. Also keep in mind that it's all about balance and finding the right fit for your own investing style. Now let's see the portfolio. Since each of these ETFs is actively managed, we're spreading our investment equally across all 5 to smooth out volatility. Some months, one ETF might lag while another outperforms, but together they create a powerful income machine. From your initial $10,000, after 1 year, your portfolio would be generating about $90 per month in dividends. Certainly nothing special or life-changing, but remember, the key is patience and reinvesting those dividends. Fast forward to 5 years, and now you're making $205 per month. That's already enough to cover a utility bill or a nice dinner out every month, just from passive income. But here's where it gets really exciting. After 20 years, your portfolio has grown into a massive $593,000. And that monthly dividend income skyrockets to over $5,200 per month. That's a full-time income purely from dividends without ever adding more money beyond your initial investment of $10,000. This is the power of compounding. Small, steady gains today can turn into life-changing passive income down the road. So there you have it, 5 monthly dividend ETFs that can turn an initial investment into a serious passive income machine over time. Whether you're looking for extra cash flow now or building for the future, these ETFs show how dividends and compounding can work in your favor. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.